All right, guys, welcome back once again. Got some job numbers in today. Got a nice interview for you today. A lot of great information. It is not a sponsored video, by the way. It is just all 100% free for you guys to enjoy, digest, and help you make some better decisions because this is a crazy environment that we have going on. So, yeah, 311,000 jobs added, soon to be revised, I'm pretty sure. But I did get to speak with Lior Gantz. He did join me for today. And we talked a little bit briefly about what to expect, what to take from this. And he's actually a financial expert. He's someone who is very influential in the market. He knows a lot more than a simple-minded guy like myself. So let me give you some of his wisdom. So stay right here. All right, thanks for joining me today, guys. We have Lior Gant from Wealth Research Group. How you doing today, Lior?
I'm doing good. Thank you for having me.
So it seems like every time we talk, we get some kind of data in, or the markets are real finicky. Today we got the jobs report in, and the numbers are a little bit higher than normal. They're down from the January numbers, which were just extremely crazy. That report has been revised, so I think it came down to around 504,000 versus 517,000 job numbers.
Yeah.
But 311,000 job gain in February. And let's see, the unemployment rate rose to 3.6%. Can you talk about what type of ammunition that the Fed still possesses coming into the March 21st, 22nd Fed meeting?
Yeah. There's a big process happening in America called redundancies. And essentially what's happening, and it started with the breaking up of supply chains during the zero COVID policies in China, and escalated and really became consensus with the war in Europe, that America is in a process of bringing jobs back. And what's really interesting about it is, from the government perspective, the reason to bring jobs back to the United States is twofold. One, fiscal policy has a lot of leeway right now. In light of what has happened in the past 10 years, where the central bank in America was the lead economic machine for growth, with slashing interest rates, etc. The Fed is now viewed in the eye of the public as the cause for inflation. And what the government is trying to do is flatten out or smoothen out the process of inflation by bringing jobs back to the United States and moving them away from China, because supply chains burden now more than ever the inflationary process. This is due to collapsing demographics in China, meaning that their economy was based for 30 years on the movement of farmers from rural areas to the cities and urbanizing, creating mega factories. But the problem is that last year, China's population shrank for the first time since the 60s, and there was no famine or any natural disaster that caused it like back then. It's because of 336 million abortions that happened during the one-child policy, and it's now a norm for a Chinese family to have one child. And what's happening is the working age population, which drove globalization into this hyper drive mode, where consumer goods were so abundant and everything worked so smoothly from the perspective of the consumer, into a society that now 52 countries have a cheaper manufacturing base than China. China's salaries, if you research this, have gone up by 1,500% in the past 20 years. And this will escalate further The population, which is around 1.4 billion people, is estimated to be around 600 to 800 million by the end of the century. Their population is in free fall. And though the government is doing everything it can to incentivize women to have more children with longer labor, maternal leaves, and helping them with first-time home buying if they have more children, etc., they just don't want to do that. So all of these factors are creating a situation where what Trump started with Mexico is just escalating and intensifying. Supply chains are moving back to Mexico and to domestic United States. And when you move factories, you're obviously creating jobs in America, but you're doing that right at a time when the baby boomers are retiring at the fastest pace they've ever done, partly because of the ramifications of the pandemic, and partly because it's time, right? So between those two things, you create a redundancy. Redundancy is when you replicate an existing factory to another country for no other reason. There's no financial reason to do it, right? There's no economic. There's reasons of diversification of supply chains and other geopolitical considerations. And this huge movement, this huge deglobalization is what's creating hot jobs numbers, because you just don't have the workers to fill these openings, and you don't have the trained workers to fill these openings. So it stays in a situation where there's way more openings than people that can occupy these jobs. And it's all happening while the country is very divided over policies of immigration. So, people are not in favor of allowing foreigners to come in and fill these jobs. So this whole salad is what's creating very low unemployment numbers, because whoever wants to get a job is getting a job. But if you look at the real numbers, there's 120, 130 million Americans working. So the unemployment, just one way to look at it. There's also what's called the participation rate, and that's very low, because most of the country, or a quarter of the country, is entering retirement. So the big picture here is that there's a shortage of workers because of mass retirement and issues over immigration, and at the same time as factories are moving back with the Inflation Reduction Act. I call it Inflation We Shall Have Act, because it's basically forcing inflation in the United States. But it's forcing it because we are in a huge reset in many industries that will last for 4 or 5 years. So the big picture is that those CPI numbers that you saw last year with 9.5%, and these might come back. This is not the end of high CPI numbers. And as you know, the CPI numbers are grossly understating the real situation that most people are feeling. So I think that as you enter the March meeting, to kind of really zoom in on your question. Question was what ammunition the Fed still has. The market is now divided over whether or not they're going to raise by 25 basis points or 50 basis points. And that's because Powell is preparing the markets for a potential 50 basis point rate hike. The problem with that, so you're asking about the ammunition. That ammunition is targeting half of the economy. Because as Powell is what Powell is saying, and he's saying that rightly, higher interest rates, they freeze the housing market, they freeze investments into VC and growth, they freeze very interest rate sensitive industries, but they cannot freeze other industries which comprise about half of the economy. So what he's basically hinting all the time is that there must be government policies that help alleviate that part of the inflation problem. And there's no real way to solve it. We're just living through an inflationary reset. So while interest rates are going to play a role, it's a limited role. If interest rates would have done anything to that part of the economy, one could argue that what already has happened would have done it. So interest rates from now on, aggressive interest rates, what they're doing is they're creating a situation where a hard landing or a recession is very likely to happen.
Yeah, I agree. And you were right as far as your government job numbers. The Fed this year, well, not the Fed, but the numbers this year so far, 164,000 of those new jobs that have been created this year have been government jobs. So that does make sense. And a lot of them are service industry jobs as well. So you're kind of just rebuilding from your pandemic jobs that were already lost.
Correct.
But you're not really adding anything of significant value. So it's really like it's a very muted jobs numbers, and it seems like you're just getting mixed results. So the Fed is, to me, getting the incorrect information, and if they're using that information to make their decisions, well, then I have to base what I want to do as far as financially off of what I think those potential impacts are going to be. And to me, if he raises 50 basis points, like you're saying as well, that tells me that I need to expect a hit in the markets and that I need to adjust what I'm doing, maybe hold a little bit of cash, and then try to either one, short, or two, buy the dip. That's pretty much what I'm reading heading into April. Would you agree to that?
Firstly, I would say if you actually want to see my portfolio, I made it available for your viewers. So you can go to wealthresearchgroup.com/portfolio and actually download my entire portfolio with some notes and what I call limit prices, the price that I like to buy these companies. And that's excluding anything commodities. So what you see in there is anything that's not commodities or mining related. It's a list of about 50 to 60 companies. Okay. And what I do, basically, to answer your question, is I look at all of them from the perspective of their quarterly reports. I go and listen to all of the quarterly reports, investor days, presentations that they have on conferences, etc. So these companies are companies that I know inside and out. And I just went through about 55 of them that have already reported the first quarter. There's only 5 left. So 95% of my portfolio is already reported. And here's a few key takeaways. And these are companies representing mostly all 11 sectors in the economy. And these are companies that are domestic and multinational. So supply chain issues raised by CEOs have mostly alleviated. So with China opening up and with everything else that's happening around the world, it looks like the big problems of 2020 and 2021 have largely been dealt with in 2022. Inflation is still a factor for many CEOs who are having issues with margins because they have to pay a lot for either components or whatever goes into the process of manufacturing or servicing. And a lot of them are debating whether or not to hire, fire, freeze. So there is a lot of debate on where is the economy? Are we in a soft landing, hard landing? If we already landed, is a recession coming or not? And I think that when it comes down to it, basically, we are in a squeeze situation. We are squeezing businesses, both small, mid-size, and multinationals, because we're raising interest rates a lot. We are obviously lowering the amount of available credit in the economy. And we're doing it at a time where baby boomers are actually exiting the stock market, moving their money either into bonds that now actually pay a nice yield, or to cash, like yourself. And you can think about it as a big withdrawal from the stock market, because you're talking 80 million people, a quarter of the country, the richest generation in history, moving out of the stock market and into either cash or bonds. And so these things really tell me that we are in a process of resetting valuations, resetting the attractiveness of stocks versus bonds, which it was a no-brainer for about 10 years, right? Stocks were way cheaper than bonds, right? And now this is not the situation at all. Now bonds are much more attractive than stocks, as a group. And so when you look at how you work around this, I think that what's really happened is there needs to be less indexing. In other words, you need to buy far less of the economy as a whole,
Mhm.
as was the case in the last 10 years, where people just bought, tech or NASDAQ, and they outperformed most of the professional hedge funds on Wall Street. Now you need to focus on your top quality companies that are able to thrive because of what's happening, because of the reset environment. So which businesses have the best business model suited for what's happening? And I think that's where your focus should be. If you're like me, meaning that you have 20, 25, 30 years until retirement.
Right.
But if you're pushing retirement or are in retirement, etc., your focus should be on the fact that interest rates have brought you to a point where you can now think about living off of lending and bonds, not to the government per se. There's so many other opportunities. For example, myself, I'm invested in credit funds where you earn 10 to 12% on your money, fixed income, no equity risk whatsoever, with very minimal negligible default rates. So it evens out to be between 10 and 12%, even after all the risks involved. So with that in mind, that is very different than the world we lived in for the past 10 years. I think that dynamic is happening in the world, and because it's not straightforward as it was before, meaning long equities, and because of the situation with inflation and the likelihood of a recession, there's also a great need out there to hedge everything with alternatives like gold, like silver, which before, most professionals would say, why would I hedge at all?
Right.
Everything is great. Inflation is tamed. Unemployment is America is doing great, etc., etc. This is not the case right now at all. So I do see, to sum it up, I do see for myself buying the dip in the most exceptional companies, one, and staying very disciplined with that. When credit is paying over 10%, find opportunities like that. That's a great return. If you think about parking your money for a year or two and making 10%, that's really attractive. And third, having a component of hedging in there with gold or with silver.
Right. Yes, I'm a very big proponent of gold. I think right now I think a lot of people are going to wake up, because I just don't and you hit the nail on the head as far as supply chains catching up. Once those supply chains catch up, you could start seeing these CEOs really let go of a lot of employees, and those job numbers could get extremely bad if that's the case. And there's also some stuff going around on YouTube. I don't put a lot of stock into it, but I don't know if you've heard of the bank Silvergate. I don't know if you were real familiar with that.
Yeah.
Does that kind of dissuade you from say, not necessarily keeping your money in the bank, but investing in
right. You're talking about Silicon Valley Bank, correct? The one that imploded today as we're doing this interview.
Yes.
Okay.
Yes.
So not Silvergate. Silvergate is like a crypto bank.
Okay.
And,
Yeah.
And Silicon, very similar to Silicon Valley and Silvergate. I mean, look, literally just 10 minutes before we jumped on the interview, the FDIC got involved and basically told all depositors, "You're safe. Don't worry." So this was a big statement from the government. Don't worry about the banks. The banks are safe, et cetera, et cetera. That's one thing. Now, people have all sorts of theories that the FDIC doesn't have the money, and I don't have any fear regarding major bank runs or keeping my money in banks, etc. When I look at the balance sheets of the world's of America's biggest banks, they're really solid, way better than 15 years ago. No, I personally don't have issues with that. It does come around every 10 years, every 12 years. People get really stressed out about banks. They read into history and see all the bank runs that are very frequent, in human history and in Europe and in the United States for the past, 100 something years. But keep in mind this: during the Great Depression, there was a bank run almost weekly. Some 5,000 regional banks closed during those years. During the 1908 panic that actually led to the birth of the Federal Reserve, there was 4,000 to 5,000 bank, and there was no FDIC. That's panic. To a large degree, if there was real panic, you'd see the smart money exiting, and so with all the compliances and regulations out there, I don't think a bank falling is the biggest concern right now for the United States. I think that the Saudis doing a deal with the Iranians, brokered by China, it should be the biggest thing on any American's mind, because what just happened is the Saudis went with the Chinese instead of with the Americans for the first time since Kissinger came to the Saudis with the ideas of petrodollar. So that's a big deal. I think that's the biggest deal. I also think that China playing this role of mediator in the Middle East, and perhaps soon in Europe, is a big threat to American hegemony and to the power of the dollar in the world. That should be concerning to Americans way more than a regional bank having issues.
Right. And I couldn't agree more. I normally don't ever speak to that. I normally don't ever talk to that, but it's like it's consumed in my comment section, and I see it all over YouTube, and it's a lot of fear, but we do have a lot of safeties in place for things like that. And you're right. You're 100% right. I don't play into it. I know a lot of people get scared. A lot of people keep zero money in the bank. I see it in my comments all the time.
Okay.
And I wanted to address it from someone who knows more than me. And you definitely.
Well, listen, you'll always get people that think that my opinion is naive or something. That will always happen. But when I look at the balance sheets of JP Morgan, of Wells Fargo, of Bank of America, these are powerhouse institutions that just went through 15 years of going through the ringer with regulators, with government, with the Fed. The best thing that happened to the banking system was the worst thing that happened to the banking system, which is 2008. Okay. After 2008, they are keeping these banks on a bigger leash than ever before, and you will not see these big banks doing what they did back then. There's none of that. If you look at exposures to the housing market, it's way different than 2008. Even though prices are falling, and monthly payments are rising drastically, We are seeing record low personal bankruptcies, and very low foreclosure rates. Now, could this interview age very badly in a year or so? It could, but if you bring me on every day, you know what I mean, and
Oh
we
yeah.
constantly talk about the reality, then I'm sure that it will age better. In other words, it's always easy to say, "Hey, a year ago you said this," and so what's important is to work with reality right now. And when I work with my money right now, with my risk management right now, with everything that I see right now, no, there is no real risk to the banking system whatsoever. And there is no risk brewing in the banking system. Interest rates are playing a great role in helping banks actually make a fortune right now. And so, and the credits, the credit scores for people who have been buying in the past few years are really high, and their jobs are paying very well. You're seeing people sticking to the monthly payments and not going away because the down payments were big, et cetera, et cetera. So, and so many things have happened with the housing market. I'm not even gonna go into it, but I mean, the amount of corporations that are buying homes in America is outrageous. I can tell you, I have more than 7 figures in funds of companies that are buying big multifamily projects. I speak to fund managers all the time, and I can tell you, America is not in any sort of existential threat or something that's along the lines of 2008 right now. Demographic trends are fine. Millennials are buying homes, and if they're not buying, they want to rent because they're moving out of their parents' houses. They're getting married at record pace, actually, and having children. So with all of that going on, even though there's so much bad news always, and in this era of information, it's always in your face. You have to put everything into these perspectives of what's really going on. Otherwise, you will always be out of the markets, out of everything, and just you cannot build wealth when all of your monies is not working in the greatest economic miracle of the past 250, 60 years, which is the United States of America. Okay.
Oh yeah, I agree. Third quarter last year, I dumped a lot into the market. I mean, a ton, and I've done quite well since then. And I mean, because I follow the Fed's blueprint. He laid it out precisely what the plan was, and he started that back in November, 2021. And as
With
soon
inflation,
as
it's
they,
not transitory. Yeah.
right, and as soon as they started letting off of that interest rate hike, that's when I started buying in heavily, and I've done quite
Smart.
well since then.
Yeah.
Because that told me that, okay, so it's time. I mean, it was plain as day to me. It was still a little scary, but I've found that whenever it's the scariest feeling, that's the time to buy.
Usually it's correct. Yeah.
So, hey, I appreciate you stopping by today, Lior. I don't want to take up any more of your time. And I'm sure my audience appreciates everything you give to us. So I just want to say thanks again.
Yeah, absolutely. By the way, another just 2 more topics that I see
Sure.
in the comment sections all the time are
Sure.
one, central banks' digital currencies.
Mm-hmm.
I don't know if that's important to you and your audience, but there's threats and risk and the whole thing. I went through this topic from A to Z. I've watched everything that's publicly available from the IMF, from the BIS, and from countries that are actually doing pilots and tests on it right now, as well as reading all the academic papers. I've summed everything up into 2 parts, and it's accessible at wealthresearchgroup.com/CBDC and /CBDC and the number 2. So CBDC 2, it's a 2-part series. It goes through everything: the risks, the threats, the benefits, who's going to benefit, How will this catch you in your personal life? Will it ever catch you in your personal life? And how the central banks are actually dealing with a lot of struggles in implementing this in general. So I think that's a great report, or two reports that people should be up on. And one more thing that I think is very important is that there is a new battlefield in the world between China and the United States, and that's it's called lower orbit. And there's a really big war going on already in who will dominate lower orbit, and it has massive military ramifications. And I'd love for people to make sure that they're aware of what's happening there, because this will impact their daily lives very soon. This is something that's actually happening right now. It's not in the news so much. I'm not talking about weather balloons. I'm talking about lower orbit. So if you want to catch up on this, go to wealthresearchgroup.com/space. It is important that you understand that topic. America is currently a dominator in that field, and it is important that people understand what's happening just right now, and billions are being put into this.
Oh, that sounds very interesting. I'm gonna have to check that out. But like I said, I appreciate you stopping by today. Thanks for all the information you provide to us, and looking forward to seeing you again.
Thank you very much.
All right, so there you go, guys. I appreciate you stopping by today. This was a pretty good fun one for me. I love getting I love getting free information. It helps me try to make better decisions for myself, whether that's silver, whether that's gold, whether that is crypto, whether that is just general market anticipation. And that is what I wanted to bring to you today. Not just all doom and gloom. I wanted to give you a little bit of something that it tells you that you should be in the market, not out of the market. You do need to have wealth. You're going to make more wealth in the market. And I think Lior presented that to you guys today. It's not everything you need to be in, but it does need to be the majority of your wealth. It does need to be in the market. I'm sorry, but it does. It's the only way you create it. Gold and silver, it's just a safe place to store some of your wealth. And that is what I wanted to give to you today. All right. So that's going to do it. Appreciate it. Keep grinding on your stack.